Every paycheck has one hidden cost: time you'll never get back. The problem is most people trade decades of time for income that eventually stops growing, right when they need it most, right when retirement comes around. So the real question becomes, what happens when you're finally tired, but your income still depends on you working? In this video, I'm going to break down a simple 3 ETF system built to fix that exact problem. We'll start by looking at what full-time work and traditional retirement planning really deliver. Then I'll walk you through the criteria behind this portfolio and the specific role each ETF plays. And in the end, I'll show you and Josh how this portfolio turns a daily $10 investment into a portfolio valued around $1.5 million that pays over $9 grand a month in dividend income. But before we get there, it's important to understand why the traditional work, save, retire path usually doesn't lead to the kind of income people expect. According to data from the U.S. Bureau of Labor Statistics, the median full-time worker in the United States earns a little over $1,100 per week. Spread across a full year, that comes out to roughly $57,000. That's the middle of the workforce, not the bottom. On paper, that sounds reasonable. It covers basic expenses, maybe allows for some savings, and offers a bit of breathing room if everything goes right. But income does not grow forever. When you look at earnings by age, a clear pattern shows up. In your 20s and early 30s, pay increases as skills and experience build. In your mid-30s through early 50s, earnings peak. This is typically when people are working the hardest, managing the most responsibility, and earning the highest paychecks of their lives. After that, income growth slows. For many workers, it flattens completely or even declines as hours reduce, roles change, or health becomes a factor. And this is where retirement enters the picture. Because just as income stops growing, the clock starts running. There are fewer working years left, fewer chances to make up ground, and eventually, paychecks stop altogether. From that point on, whatever you've built is what you're expected to live on. And when you actually look at what most people have built by then, the picture gets uncomfortable. The average 401k balance for people between the ages of 55 and 64 is about $271,000. But averages are heavily skewed by high earners. The more revealing number is the median, which shows what the typical worker actually has. For that same age group, the median 401k balance is just under $96,000. That's after decades of full-time work, decades of contributing, decades of following the standard advice: work hard, save consistently, don't take big risks. The problem is that a balance is not income. Even $271,000, let alone $96,000, does not replace a paycheck. Once you factor in inflation, rising healthcare costs, and the possibility of spending 20 or 30 years in retirement, those numbers start to feel extremely tight. So the issue isn't that people didn't try hard enough. They worked, they saved, they showed up year after year. The issue is the structure itself. When income depends entirely on hours worked and the end goal is a single account balance, there's a built-in limit to how far that system can go, which naturally leads to a different way of thinking. Not about working more or saving harder, but about building something that doesn't shut off when the paychecks do. Something that can keep growing and producing income even when you're no longer trading hours for money. And once you start thinking that way, it becomes clear why piling on more complexity usually doesn't solve the problem. It usually makes it harder to stick with anything long enough to work. That's where the idea of simplicity starts to matter, not as a shortcut, but as a survival strategy for long-term investing. The financial world is built on the idea that more activity means better results. More charts, more indicators, more trades, more opinions. Turn on any financial channel and you'll see constant movement, urgency, and noise. But interestingly, some of the most successful investors in history have warned against this mindset. Warren Buffett has repeatedly said that most investors don't need complexity to succeed. His advice has stayed simple for decades. Own broad, low-cost funds, stay invested, and let time do the work. He said that for most people, a basic index-style approach beats complicated strategies over the long run. The reason is surprisingly practical. Every extra decision adds friction. Every choice creates another chance to mess things up. The biggest mistakes don't come from buying bad assets. They come from selling good ones too early because fear or noise takes over. Simplicity removes those traps. When you know exactly what you own and why you own it, you're less likely to panic during downturns or chase trends. You're not jumping in and out based on news. You're following a plan that's designed to hold up through full cycles, not just good years. This is where consistency becomes the real advantage. Many investors fail not because they lack intelligence, but because they change strategies too often. They confuse motion with progress. So the real question isn't how to outsmart everyone else, it's how to stay out of your own way. That's why simple, rules-based ETFs matter. They're built to be held. They do the heavy lifting in the background. The next step is to focus on choosing the right ETFs. Not a long list, not a complicated mix, just a few that each have a clear job inside a system built to last. And in the end, I'll show you and Josh how this 3 ETF portfolio turns a daily $10 investment into a portfolio valued around $1.5 million that pays over $9,000 a month in dividend income. But for that to work, we can't pick ETFs at random. We need a few clear rules for how they're chosen. With thousands of ETFs available, the hardest part isn't finding options, it's filtering out the noise. Most people get stuck comparing ticker symbols, recent performance, or whatever just did well last year. That usually leads to chasing, second-guessing, and constantly switching things around. This portfolio works the opposite way. Instead of starting with what looks exciting, it starts by defining roles. What do you need this ETF to actually do for you? The first thing that matters is track record. Markets go through all kinds of conditions: good years, bad years, recessions, recoveries. ETFs that hold up across multiple cycles usually do so because they're built on solid foundations, not because they got lucky with timing. Then there's dividends, but not the way they're often talked about. The goal isn't to grab the highest yield you can find. Big yields can look attractive, but they're often a warning sign. What matters more is whether those dividends are sustainable. Are they coming from real cash flow? Are they supported by healthy businesses? Have they been paid consistently over time? Just as important is dividend growth. A dividend that slowly grows year after year doesn't feel impressive at first, but over time, those increases stack. What starts as modest income turns into something meaningful, without you having to add more money or make constant changes. Growth is the next requirement. Income alone doesn't scale fast enough. The portfolio needs exposure to assets that reinvest profits aggressively and expand over time. Share price appreciation increases the size of the base that future income builds on. Without growth, income eventually hits a ceiling. Then comes risk, not eliminating it, but managing it. Spreading exposure across sectors, countries, and business types reduce the chance that one bad outcome derails everything. And finally, the underlying businesses, also known as holdings, matter. Each ETF needs broad diversification, strong underlying businesses, and exposure to products and services people rely on regardless of economic conditions. With that framework in place, let's start with the portfolio. This portfolio follows 3 simple rules. Each ETF has one clear job: income, growth, and stability. And together they balance each other so no single outcome can break the system. With that in place, the first ETF is the one responsible for steady income and stability. That role belongs to SCHD. SCHD earns its spot because it does something that's surprisingly hard over long periods. It stays dependable. This ETF is designed around U.S. companies that consistently generate cash and return a portion of it to shareholders, which becomes clear when examining its long-term performance, income profile, and risk behavior across different market environments. Over the most recent year, SCHD has been essentially flat, down about 1.3%, and that's actually the point. While more aggressive portfolios were swinging around, SCHD was doing what it's designed to do, holding its ground and continuing to pay. Now, when you zoom out over the last 5 years, SCHD's share price is up roughly 29%. Over the past 10 years, it's grown about 112% in price. That means it hasn't just been paying income, it's been steadily increasing in value at the same time. If you look at SCHD on a price chart, it's doing something very simple and very important. Right now, SCHD is trading around $27.50, which puts it slightly above its short-term and long-term averages. Its 10-day average is about $27.64, the 50-day sits near $27.09, and the 200-day is around $26.94. In plain terms, the price is sitting above where it's been over the past few weeks, months, and even the past year. This positioning suggests that SCHD is maintaining an upward bias relative to its longer-term trend lines, even during periods of muted price action. SCHD manages just under $72 billion in assets, which places it among the largest dividend ETFs available. That size isn't about bragging rights, it's about stability. Large established funds tend to track more smoothly and are far less likely to run into operational issues, especially during volatile markets. Liquidity is another reason SCHD fits this role so well. On a typical day, around 18 million shares trade hands, representing close to $500 million in daily volume. That means you can buy or sell without worrying about the price jumping around or trades not going through. Even during market drawdowns, when liquidity can dry up elsewhere, SCHD stays easy to move in and out of. From a risk standpoint, SCHD sits in a comfortable middle ground. Its volatility is around 16%, which is slightly lower than the overall stock market. In practice, that means SCHD usually swings less when markets move. It's not as slow and rigid as ultra-defensive assets, but it's also far calmer than aggressive growth strategies that can drop hard and fast. That balance is the reason SCHD works so well here. It smooths out extreme ups and downs without completely giving up long-term growth. You still get appreciation over time, just without the stomach-churning swings that knock people out of their plan at the worst moments. When you look at what SCHD actually owns, its behavior starts to make a lot of sense. The fund holds 102 companies, and the top 10 make up about 41% of the portfolio. That means it's diversified, but not so spread out that nothing matters. The biggest positions are well-established businesses like Merck, Cisco, Amgen, Coca-Cola, Pepsi, Chevron, and Lockheed Martin, companies that sell things people and governments rely on year after year. That same idea shows up in the sector mix. About 19% of the portfolio sits in energy, roughly 18% in consumer defensive companies, and around 17% in healthcare. Industrials make up just over 10%, and technology is close to 10% as well, but it's focused on mature, cash-producing tech companies, not speculative growth bets. And that's exactly why it works as the foundation. Once that base is in place, the portfolio can afford to add something very different next: aggressive growth. That's where QQQ comes in. After QQQ, I'll show you one more ETF that completes the portfolio, and then at the end, I'll walk you and Josh through how this 3 ETF setup turns a simple $10 a day habit into a portfolio worth around $1.5 million, paying over $9,000 a month in dividend income. But first, let's see what QQQ is all about and its role in this portfolio. QQQ earns its place by doing what very few investments can sustain over long periods, delivering aggressive growth without relying on short-term speculation. This ETF is built around the largest non-financial companies listed on the NASDAQ, which means its success is tied directly to innovation, scale, and long-term earnings expansion rather than defensive income strategies. And the numbers make that clear. Over the most recent year, QQQ is up around 13%, even in a market that's been uneven and volatile. Zoom out to 5 years, and the fund is up roughly 97%, nearly doubling in value. Stretch that view out to 10 years, and QQQ has delivered about 440% total return, meaning long-term investors saw their money grow more than 5 times. This performance highlights that QQQ is not driven by isolated rallies, but by persistent growth from companies that continuously expand revenue, margins, and global reach. From a technical perspective, QQQ reflects strength rather than fragility. The ETF's 10-day simple moving average sits near $622.06, while the 50-day moving average is around $613.56, and the 200-day moving average is approximately $550.52. The current price trades slightly below the shorter-term averages, but remains well above the 200-day trend. This configuration suggests short-term consolidation within a clearly intact long-term uptrend. QQQ is massive, and that matters more than people realize. It manages a little over $400 billion in assets, which puts it among the largest ETFs in the world. At that size, operational risk is extremely low. The fund tracks its index closely, and there's no concern about it functioning properly during volatile markets. Liquidity is one of QQQ's biggest strengths. On an average day, more than 58 million shares trade, representing over $35 billion in daily volume. That means buying or selling QQQ is rarely an issue. Even during market stress, trades go through cleanly without large price swings. From a risk standpoint, when it comes to price movements, QQQ sits on the opposite end of the spectrum from income-focused ETFs like SCHD. Its volatility is around 24%, which means it moves more, sometimes a lot more, than the average ETF. Bigger swings are part of the deal here. When growth stocks fall out of favor, QQQ can drop quickly, but that same volatility is also what allows it to grow much faster over long periods. When you look at what QQQ actually holds, both the upside and the volatility make sense. The fund owns 102 companies, but the top 10 make up about 53% of the portfolio. That's a high level of concentration, and it's intentional. The biggest positions are companies like Nvidia, Apple, Microsoft, Broadcom, Amazon, Alphabet, Tesla, and Meta, businesses that sit at the center of innovation and global growth. This shows up clearly in the sector mix. About 55% of QQQ is in technology, around 16% in communication services, and roughly 13% in consumer cyclical companies. Healthcare is much smaller, under 5%. That concentration at the top is what drives the compounding. QQQ functions as the growth engine. Its job is simple: grow the capital base as much as possible so future income has more room to expand. But growth on its own isn't enough. If everything is tied to one country, one style, or one type of company, the whole system becomes fragile. That's where balance comes in. For this, I have INTF. INTF plays a very different role. While SCHD is focused on dependable income and QQQ is built for aggressive growth, INTF is designed to balance the entire system by spreading risk across global markets and emphasizing quality factors that tend to hold up over time. INTF is an international equity factor ETF, which means it does not simply buy every stock outside the United States and call it diversification. Instead, it applies a rules-based screening process that tilts toward companies with stronger fundamentals. These are businesses that score well on metrics like profitability, balance sheet strength, and earning stability. From a performance standpoint, INTF has delivered steady and meaningful results. Over the most recent year, the fund is up about 25%, which surprises a lot of people who assume international investing always lags. Over the past 5 years, it's gained roughly 38%. Stretch that out to 10 years, and the total price appreciation is around 56%. Right now, it's trading around the mid-$37 range. Its short-term average sits near $37.47. The 50-day is around $36.58. And the 200-day is closer to $34.29. The price is slightly below the short-term level, but still comfortably above both the medium and long-term averages, about 2% above the 50-day and nearly 9% above the 200-day. In plain terms, it's taking a short pause, but the long-term trend is still clearly moving higher. That's normal behavior for a fund designed to move steadily, not aggressively. INTF is also large enough to be reliable. It manages about $2.8 billion in assets. That's smaller than SCHD or QQQ, but it's still well above the average ETF. It's big enough to operate smoothly, track its strategy properly, and avoid the issues that come with tiny or thinly traded funds. On an average day, about 220,000 shares trade, which comes out to roughly $8 million in daily volume. That's more than enough to buy or sell without worrying about price jumps or getting stuck in a trade. The risk data really explains why INTF plays this role so well. Its standard deviation is about 9.2, which is lower than many broad stock ETFs. Annualized volatility sits around 16.6%, right near the market average, but it gets there in a very different way. Instead of leaning on a handful of massive positions, INTF spreads risk widely. Only about 11% of the portfolio sits in its top 10 holdings. Compare that to QQQ, where more than half the fund is concentrated in the top 10 names. Sector exposure is another key piece. INTF is heavily diversified across financials at around 26%, roughly 19% in industrials, around 10% in consumer cyclical companies, a little over 8% in healthcare, about 8% in technology, and just over 7% in consumer defensive stocks. No single sector dominates the fund. This balance reduces the impact of sector-specific downturns, especially when technology or growth stocks fall out of favor. Geographically, the exposure is just as broad. INTF holds companies across developed international markets, including names like Novartis, ASML, Royal Bank of Canada, Roche, Nestle, AstraZeneca, SAP, and ABB. These are large, established businesses with long track records, global revenue streams, and strong positions in their industries. INTF is not meant to steal the spotlight. Its job is to reduce dependency on any one country, sector, or economic cycle. Now, when you combine SCHD, QQQ, and INTF, you no longer have 3 separate ETFs, you have a complete portfolio. Each fund serves a specific role, and together they form a system built around income, growth, and balance. Let's step back and take a look at how these three ETFs come together as a single portfolio and what the structure actually delivers over time. Using the allocation and metrics, this portfolio is intentionally structured to balance income reliability, growth acceleration, and global diversification. The largest allocation, SCHD, at 50%, anchors the portfolio with income and stability. SCHD delivers a 3.78% current dividend yield and a 10-year dividend growth CAGR of 10.61%, supported by an annual share price appreciation of 7.88%. This makes SCHD the primary cash flow engine while still contributing meaningful long-term growth. Its role is to compound steadily and reduce portfolio volatility. QQQ at 20% is the growth accelerator. Although its current dividend yield is only 0.48%, it compensates with strong capital appreciation, posting 18.51% annual share price appreciation. This slice is what drives long-term expansion. It grows the size of the portfolio itself, which matters because a larger portfolio makes future income strategies far more effective. INTF at 30% adds international diversification and factor-based exposure. With a 2.6% dividend yield and an impressive 19.36% dividend growth CAGR, INTF strengthens income growth outside the US. Its 4.8% annual price appreciation is lower than both SCHD and QQQ, but contributes stability and reduces geographic concentration risk. When combined, the full portfolio produces a 2.77% average dividend yield, a 13% dividend growth CAGR, and 9.08% annual price appreciation. This data confirms the portfolio is not dependent on a single return driver. Instead, income growth, capital appreciation, and diversification work together to support consistent long-term compounding. To see what this structure actually does, let's run it through time. To understand how this strategy plays out over time, suppose Josh invests $10 per day in this portfolio. After the first year, Josh will have contributed about $3,650. Early on, this stage will be about setting the foundation. By year 10, daily investing and dividend reinvestment grow the portfolio to approximately $66,000, generating about $2,000 in annual dividends. By year 20, the portfolio value is projected to reach roughly $315,000 with annual dividend income of about $16,000. At this point, most growth comes from reinvested dividends and capital appreciation rather than new contributions. Then comes year 30. Josh's total lifetime contributions will add up to about $109,500, but the portfolio value will reach roughly $1.5 million. Dividend income alone will be around $107,000 per year, which works out to about $9,000 a month. Now let's bring this back to where we started, the reality of retirement. For most people, decades of full-time work lead to a retirement account that looks okay on paper but struggles in real life. The median 401k balance near retirement sits under $100,000. Even the average, which is pushed up by high earners, is only around $270,000. Those numbers aren't income, they're balances. And when retirement begins, those balances start moving in one direction, down. To live on them, withdrawals have to be made, year after year, while inflation, healthcare costs, and market swings keep applying pressure. The longer retirement lasts, the tighter the math gets. Now compare that to what this portfolio is designed to produce. Using the same long-term assumptions we walked through, a $10 a day habit could grow into a portfolio worth roughly $1.5 million over 30 years. That's not a small difference. It's a completely different starting point. But the bigger gap shows up in income. Instead of relying on withdrawals from a shrinking balance, this portfolio is built to generate cash flow. At that stage, dividend income alone could be around $107,000 per year, roughly $9,000 a month, while the portfolio itself continues to exist and compound. Traditional retirement planning focuses on saving a balance and hoping it lasts. This approach focuses on building a system that produces income. And that's why the structure works. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on screen to find out.